Welcome, deep divers. Today, we're really going to unpack BigBear.ai, ticker BBAI. This is a company that's, well, it's standing at a fascinating
It
crossroads.
really is.
And the core question we're wrestling with today is this. You've got this company riding the huge AI wave, but can it really be undervalued? Or are its, fundamental challenges just too significant for the stock price right now?
That's the central tension, exactly. Narrative versus reality.
So by the end of this deep dive, our goal is to give you a much clearer picture. Is the market pricing the story or the financial facts on the ground?
We'll cut through the noise, look at the data.
Right. Our mission is a comprehensive understanding. We're looking at this as of September 12th, 2025, and the shares are trading around $5.06. Now, before we plunge in, just a quick note. This deep dive, like all our work, is powered by Stock Analytics AI.
Yep.
For just €4.99 a month, members get priority on deep dives for tickers they request. And we've got big plans. We're aiming to cover all the S&P 500 stocks over the next few months, and members get exclusive access to that.
It's a huge project.
It is. And if you just want a one-off deep dive on a specific company, you can always drop us a super thanks. Okay, let's get into BigBear.ai.
The core foundation.
Business analysis.
Okay, so first things first. Let's get to the heart of what BigBear.ai actually does. They call themselves a provider of decision intelligence solutions.
Right. Think of it like this. They use advanced data analysis, predictive modeling, that kind of thing, to basically help humans make better decisions, especially in really complex, high-stakes situations.
And their business model isn't just software, is it?
No, that's crucial for you to understand. It's a hybrid. They make money from their software, yes, but also from what they call high-touch professional services.
Okay.
And critically, they are heavily reliant on the U.S. public sector. We're talking defense, intelligence agencies. That shapes everything.
And looking at that, the data from 2024 shows 56% of their revenue was from time and material contracts, so billable hours, basically.
Exactly, billable hours. And another 29% came from fixed price projects. And that time and material model, it's a challenge if you want to be seen as a true tech company. It kind of puts them in a, let's call it a services trap.
How so?
Well, unlike pure software as a service, SaaS, where you can scale massively, time and material often means your revenue growth is tied directly to hiring more people. More hours billed means more staff needed.
Right. It limits scalability.
It really does. You're selling hours, not just tech licenses. Plus, a lot of their sensitive government work needs people on-site co-located, which adds another layer of complexity.
Okay. But despite those challenges, they do have some pretty impressive tech in their portfolio, right?
Yeah.
It's designed for these complex environments.
Oh, absolutely. It's not generic AI stuff. Their offerings are highly specialized, often mission critical.
Can you give us some examples?
Sure. You've got Conductor OS, that's for AI orchestration and sensor fusion, working right at the edge, processing data where it's collected out in the field. Then there's TrueFace and Veristand for digital identity, like facial recognition, biometrics. That area got a big boost from their Pangiam acquisition.
Ah, yes, Pangiam. We'll come back to that.
So, definitely. They also have Arcosci for computer vision, analyzing images and video, and cybersecurity tools like Spacecrest and Troy. Then there's predictive intelligence platforms, Observe and Van, which are used by folks like the DoD Joint Staff for forecasting threats.
Wow, quite a range.
And finally, things like ProModel and Dominate for modeling and simulation. Think digital twins for supply chains or even hospitals.
So specialized tech, but how big are they in the grand scheme? Still small cap, right?
Yeah, very much small cap. Market cap around $1.88 billion. They've really focused on that specific niche. National security, supply chain, digital identity, mainly for the U.S. intelligence community and DoD.
And that Pangiam acquisition in early 2024, that seems like a big strategic move.
Absolutely pivotal. The clear goal was to expand their vision AI capabilities, things like facial recognition, and crucially to try and diversify into commercial markets and think global trade, travel, transportation security.
So trying to reduce that government dependency.
Exactly. How well they integrate Pangiam and actually win in those commercial spaces, that's going to be really important to watch.
So boiling it down, their main value proposition is what? Delivering clarity for the world's most complex decisions. That's about custom, mission-critical solutions, not just off-the-shelf software.
That's it. And that mission-first culture is key for their government clients. Another really vital point is their commitment to open architecture. Meaning their systems are designed to play nice with existing government systems to avoid vendor lock-in. That's a huge deal in those complex government IT ecosystems.
Okay, let's zoom out a bit. The overall AI market is just exploding, right? The numbers are staggering.
Absolutely staggering. We're talking maybe $294 billion globally this year, projected to soar past $1.77 trillion by 2032. That's almost a 30% compound annual growth rate. It's massive.
So a huge tailwind for anyone in AI.
A massive tailwind. And even within that, their specific focus areas are growing fast too. Decision intelligence could be a $36 to $92 billion market by the early 2030s. And AI in defense and security, their core, is expected to nearly quadruple to almost $40 billion by 2033.
The market opportunity is definitely there.
No question. The backdrop couldn't be better, theoretically.
Theory and reality. The competitive landscape must be brutal.
Oh, it's intense. Despite those great trends, they face serious competition from multiple angles.
Like who?
Well, you got the pure play AI companies, obviously Palantir, which is much larger, profitable, more diversified. Then there's C3.ai, SoundHound AI.
Okay.
Then you have the huge traditional government and defense contractors, Lockheed Martin, Northrop Grumman, Leidos. They have incredibly deep relationships, huge resources, and they're building their own AI capabilities internally too.
Right, the incumbents.
Exactly. And finally, don't forget the major IT and cloud consulting firms, Accenture, Deloitte, IBM Consulting. Their services often overlap with BigBear's professional services side.
And being a government contractor adds another layer of complexity, the regulations.
Oh, yeah. The Federal Acquisition Regulation, FAR, the intense oversight security clearances. It's a complex world.
Creates barriers to entry, I suppose.
It does create high barriers, absolutely.
Yeah.
But it's also a risk. The government can terminate contracts for convenience, which adds uncertainty. Plus, you have the whole emerging landscape of AI regulations globally adding another wrinkle.
So what are those fundamental barriers?
Deep technical and domain expertise is critical. You need a proven track record of trust and security. You need established relationships to navigate government bureaucracy. And integrating with legacy government systems is often complex and expensive. These are serious hurdles.
Given all that, what are their actual competitive advantages? They have brand strength in their niche, right?
Yeah.
Defense and intel.
They do.
Yeah.
In that niche, yes. And they're trying to broaden that visibility with things like the Washington Commanders Partnership, the Nashville Airport deployment for biometric screening.
Okay.
But, and this is important, the sources point out a lack of significant cost advantages or real economies of scale right now. They're unprofitable, gross margins are negative. That service-heavy model really limits their ability to scale efficiently like a software company.
But maybe high switching costs once they're embedded. If a client uses their platform deeply, it's hard to rip out, right?
Exactly. That creates sticky client relationships, which is a plus. But here's what might be their most unique, hard-to-copy asset. Their people.
The human capital.
Yes. That blend of deep tech skills combined with actual military and intelligence background, it means they can understand the mission challenges in a way few others can and tailor solutions accordingly.
And the CEO appointment ties into that.
Dramatically. Bringing in Kevin McAleenan, the former acting Secretary of Homeland Security, as CEO. That provides unparalleled access and understanding of the government ecosystem. It's a powerful, unique asset.
But you mentioned a double-edged sword earlier.
Right, because that deep government reliance, while an advantage in some ways, also concentrates their risks significantly. Their fortunes are tied to government budgets, political shifts, things outside their direct control.
Management evaluation.
Okay, moving on. Let's talk about the leadership, the people actually steering the ship. Big changes there recently.
Very significant changes. Mandy Long, who came from a more traditional tech background, was CEO from October 2022. But she was replaced in January 2025 by Kevin McAleenan with his deep government roots as former acting DHS secretary.
That feels like a major strategic signal.
It's a profound signal, I think. It suggests they're really doubling down on leveraging those deep federal relationships, prioritizing that insider understanding over maybe a more conventional tech commercialization strategy.
Interesting. And the team overall seems quite new.
Exceptionally new. The average tenure for the management team is just 0.8 years. It's incredibly short. Plus, they currently have an interim CFO, Sean Ricker. It really points to a company in significant transition. The COO, Carlo Napolitano, does provide some continuity, though.
And how are they on communication and transparency? Standard stuff.
Seems like standard public company communications, SEC filings, press releases, the usual.
Yeah.
Although, for an investor looking in, those abrupt leadership changes could definitely raise some concerns about underlying stability.
Makes sense.
On a different note, something interesting in their 10K. They explicitly state They'll only work with customers aligned with Western liberal democracy.
Hmm.
Now, that obviously limits their potential market, but it probably strengthens their brand significantly with their core U.S. government clients who value that kind of alignment. It's a principled stand, but also strategic.
Okay, let's look at capital allocation. How are they using their money? M&A seems big.
M&A appears to be the primary growth lever right now, yeah. That all-stock acquisition of Pangiam in early 24 is the prime example, trying to bolt on those vision AI and biometrics capabilities.
And R&D spending?
Relatively modest, actually, about $10.9 million in 2024. Compare that to selling, general administrative expenses, SG&A, which were $81.5 million.
That does raise a question.
It does. It makes you wonder about the long-term innovation pipeline if R&D isn't getting more investment relative to sales and admin costs. And importantly for you, the investor, using stock for acquisitions when you're unprofitable, well, it avoids burning cash, but it directly dilutes existing shareholders. That's a key trade-off they're making.
And given they're unprofitable and focused on growth, no dividends or buybacks, right?
No, none expected. Any capital they have is going back into trying to grow the business or manage debt.
Which brings us to return on invested capital, ROIC. That's like the report card for management spending, right?
Exactly. It shows how effectively they're using the money entrusted to them. And for BigBear.ai, well, the ROIC is deeply negative, minus 108.76%.
Wow.
Yeah. For you, that basically means their investments are currently losing significant amounts of money. Now, okay, that's not uncommon for young, high-growth, unprofitable tech companies. But it underscores how absolutely critical it is for them to find a clear path to positive ROIC for any kind of long-term sustainable success. The growth story needs to eventually translate into profitable investment.
Financial analysis.
Okay, now for the numbers. Let's really dig into the financial health or lack thereof for BigBear.ai. Market cap, we said, $1.88 billion. Small cap territory. Higher potential growth, but definitely higher risk and volatility.
Precisely.
Now, looking at revenue growth over the last 5 years, it's not great, is it?
No, it's a concerning picture. They had strong growth from 2020, about $91 million, up to $155 million in 2022, but then flatlined. Revenue basically stayed stuck around $158 million through 2024.
And it's gotten worse recently.
Alarmingly so. The latest numbers for Q2 2025 showed revenue actually dropping to $32.5 million. That's an 18% decrease compared to the same quarter last year. Yeah. And as a result, management had to slash their guidance for the full year 2025 down to a range of $125 million to $140 million. That's a significant decline.
So the AI industry is exploding, but their revenue is shrinking.
Exactly. And that disconnect is a major red flag.
Mm-hmm.
It strongly suggests fundamental challenges, maybe with execution, maybe competitive pressures, maybe something inherent in their business model isn't working as hoped.
And the profit margins? Tell me they're better.
Afraid not. The margins really highlight the financial distress. Gross margin on a trailing 12-month basis is around 28%. That's pretty thin for a company positioning itself as tech.
Okay.
Operating margin is deep in the red, negative 36.7%. And the net profit margin is frankly alarming, negative 269.3%.
Minus 269%.
Yes. In Q2 2025 alone, they lost $228.6 million on just $32.5 million in revenue. Now, to be fair, that included some large non-cash charges, but still.
Still shows massive losses relative to sales.
Absolutely. It paints a very clear picture of significant financial distress.
What about free cash flow? Are they generating cash from the business?
No, that's another critical indicator pointing the wrong way. They have a consistent history of negative free cash flow. They are burning cash.
How much?
Trailing 12 months, cash from operations was negative $27.23 million. So the core business is not self-sustaining. It needs cash from reserves or external funding to keep going.
And this isn't new, the unprofitability.
Not at all. It's a clear, consistent trend. Net losses have widened significantly from about $123.6 million in 2021 to $295.6 million in 2024. Losses have grown about 42% per year over the last 5 years. It's heading in the wrong direction.
How does the balance sheet? Debt.
Well, their reported debt-to-equity ratio is 0.42, which might look moderate, but that can be misleading because they've had negative shareholder equity in the past. More concretely, they were carrying over $200 million in convertible notes debt at the end of 2024. Now, they did improve the balance sheet recently. They reported a record cash balance of $390.8 million in Q2 2025, and net debt was reduced. But and this is crucial for you to grasp this, wasn't because the business suddenly became profitable.
It was from issuing new shares, right? The dilution we talked about.
Exactly. They raised cash by selling more stock, which dilutes the ownership stake of existing shareholders. It shores up the balance sheet short term, but it comes at a cost to current investors.
But the short-term liquidity looks okay now. Current ratio.
Yes, the current ratio is strong at 1.91. That does indicate they have enough liquid assets to cover their short-term liabilities, largely thanks to that cash infusion.
Okay, let's talk valuation. Price to earnings, PE ratio, is useless here because they have no earnings.
Right, PE is meaningless when earnings are negative.
So we look at price to sales, PS.
Exactly. For unprofitable growth companies, PS is often more relevant. Their trailing 12-month PS ratio is around 12.4x.
How does that stack up against competitors?
It's interesting. Palantir trades way higher, around 118x PS, but they're profitable and growing revenue at nearly 40%. C3.ai is lower, around 7.7x. SoundHound AI is higher, around 43.6x.
So BBAI is cheaper than Palantir and SoundHound, but more expensive than C3.ai.
Correct. But here's the kicker, the most striking comparison point. BigBear.ai's negative revenue growth. That negative 18.4% decline last quarter stands in stark contrast to its peers who are generally growing.
So the discount might be justified, or maybe not even enough of a discount given the shrinking revenue.
That's the key question the market is grappling with. The negative growth makes that 12.4x PS look potentially quite rich, even compared to peers. It suggests the valuation discount is absolutely warranted by the poor underlying performance.
Okay, what about intrinsic valuation? Trying to estimate its true worth with a discounted cash flow or DCF model.
Right. DCF tries to value a company based on its expected future cash flows, discounted back to the present value, factoring in risk.
But how do you do that for a company burning cash with no profits?
That's the problem. For a company like BigBear.ai, any DCF is highly speculative. Its value relies entirely on assumptions about a future turnaround that, frankly, hasn't happened yet and isn't clearly on the horizon.
So it's more of an academic exercise.
Pretty much. Using an educational model and making some very optimistic assumptions about them eventually turning profitable and generating positive cash flow, you get a wide estimated intrinsic value range of $2.50 to $4.50 per share.
And those assumptions are key.
Absolutely critical and highly uncertain. We're talking assumptions like 15% annual cash flow growth for 5 years, but only after they achieve positive free cash flow, which itself might be 3-4 years away, if ever, then a 2.5% terminal growth rate. And importantly, we have to use a high discount rate to reflect the huge risk.
How high?
We use 12% for the weighted average cost of capital, WACC. That incorporates things like the risk-free rate, the equity risk premium, and crucially, a very high beta of 3.16.
Beta of 3.16, meaning
The stock is theoretically over 3 times more volatile than the overall S&P 500 market. It reflects just how risky this investment is perceived to be. So higher risk means future potential earnings are worth less today.
external dynamics and conclusion.
Market sentiment.
Okay, so we've got the business, the shaky financials.
Yeah.
How is the market actually feeling about BigBear.ai? What are the analysts saying?
Well, the Wall Street analyst consensus is actually cautiously optimistic, leaning towards buy or moderate buy.
Really, despite the numbers?
Yep. The average 12-month price target falls somewhere between $5.83 and $6.75. That suggests a potential upside from today's $5.06 price, maybe 15% to 33%.
Okay, but
That average hides a very wide range of opinions. Individual targets go from as low as $3.50 all the way up to $9.
wow, that's a huge spread.
It is, and that wide dispersion tells you there's a high degree of uncertainty and disagreement among the analysts themselves about the company's prospects.
What about recent news? It seems like a mixed bag.
Definitely mixed. You get positive operational headlines, like the Washington Commanders deal or the Nashville airport deployment, good PR. But
Yeah.
then you get hit with the negative financial news, that Q2 earnings miss, the lowered guidance.
Right.
And the general media tone kind of reflects that split personality. Lots of talk about the AI promise, but almost always contrasted with the persistent financial struggles and those often unfavorable comparisons to Palantir.
Now let's talk short interest. That's investors betting the price will fall, right?
Exactly. And this, for me, is one of the most telling indicators right now.
Okay.
BigBear.ai has extremely high short interest. It's sitting at 19.78% of the public float.
Nearly 20%. That's huge.
It's massive. That signals deep, deep bearish sentiment from sophisticated market participants, people putting serious money behind their bet that the price will go down. It's a major red flag about market confidence, kind of contradicting those analyst buy ratings.
What about technical indicators like moving averages?
Well, the current price, $5.06, is below its 50-day simple moving average, which was around $6.36. That typically indicates a bearish trend in the short to medium term.
And the longer-term view, the 200-day average.
The 200-day is actually quite ambiguous right now. Depending on the specific calculation source, it's hovering around $4.59 to $5.00. The price is kind of dancing around it.
So no clear long-term signal there.
No clear signal. It suggests the long-term trend is pretty fragile, could break either way. Not strong confirmation for bulls or bears from that indicator alone.
Ownership structure.
All right, let's look at who actually owns BigBear.ai, who holds the shares. Institutions own a decent chunk, right?
Yeah, institutional investors hold somewhere around 34–35% of the stock.
Okay, who are the big players?
Well, the top holders are mostly the giant passive index funds. Vanguard has about 6.5%, BlackRock around 6.3%.
So they own it mainly because BBAI is in an index, like the Russell 2000,
Yeah.
not necessarily because they love the company.
That's exactly right. It's primarily index inclusion ownership, not necessarily a high conviction, active investment decision saying, we believe strongly in BigBear.ai. Any recent increases you see of their holdings are likely just automatic rebalancing adjustments because the company issued more shares, not necessarily new bullish bets.
What about insiders, management, board members?
Insider ownership is actually quite low, somewhere between maybe 0.8% and 3.4%.
Low. And are they buying or selling?
Now this is probably one of the most powerful takeaways from the ownership data. The trend is overwhelmingly, massively towards selling.
How much selling?
Over the past 12 months, insiders and major shareholders have sold a staggering 145.4 million shares.
145 million, compared to how many bought?
Compared to only about 2.1 million shares purchased.
Wow, that's incredibly lopsided.
It's incredibly lopsided. This includes huge sales by their original private equity backer, AE Industrial Partners, and also by Pangiam stakeholders after the acquisition. For you as an investor, this is effectively a massive vote of no confidence from the people who know the company best. It's one of the strongest bearish indicators you can find.
Okay, so if institutions own about a third and insiders own very little and are selling heavily, who owns the rest?
The ownership is highly diffuse. The top 25 shareholders combined own less than 28%. A very large chunk, around 65%, is held by the general public, retail investors.
What does that imply?
Well, it raises an interesting question for you to consider. How might this high retail ownership impact the stock's behavior? Retail investors can sometimes be more influenced by sentiment, by the story, rather than just the cold, hard fundamentals.
And maybe more likely to absorb those huge insider sales.
Potentially, yes. It can certainly contribute to higher volatility in the stock price.
Risk assessment.
Okay, every investment has risks. Let's lay out the pros and cons using a SWOT analysis. Strengths, weaknesses, opportunities, threats. What are BigBear.ai's core strengths?
Their strengths lie in that deep domain expertise, particularly in defense and intelligence. They have entrenched relationships within the U.S. government. They possess a portfolio of proprietary AI technology, and as we discussed, that strategic leadership under the former acting DHS secretary is a unique strength.
Makes sense. Now, the weaknesses, we've hit on these already, but let's recap.
Yeah, the weaknesses are pretty stark and mostly financial. Persistent unprofitability. Negative cash flow, they burn cash. Heavy customer concentration on the U.S. government, those scalability challenges tied to the service-heavy model. And as we noted, the recent leadership instability, that high executive turnover.
Okay. What about the opportunities? Where could things go right?
Well, the biggest opportunity is the market itself. That secular growth in AI, decision intelligence, cybersecurity is huge. There's potential for increased government spending, especially with ongoing geopolitical tensions and AI modernization pushes. The Pangiam acquisition could open doors for real commercial expansion. And there's always the opportunity to cross-sell more services and products to their existing government clients.
And the flip side, the threats.
Threats are substantial too. Intense competition, as we discussed, from Palantir, big defense contractors, consulting firms. Government budgetary risk is always there. Funding shifts, shutdowns, contracts getting canceled.
Yeah, the termination for convenience clause.
Exactly. There's the constant threat of technological obsolescence. AI moves incredibly fast and huge execution risk. If they fail on a mission-critical deployment, the reputational damage could be severe.
Let's also talk broader economic factors. Inflation and interest rates, how do they impact BBAI?
They pose a dual threat, really. For those fixed-price government contracts, inflation is a killer. Rising labor costs, operational costs, they squeeze margins directly, especially if the DoD is reluctant to grant adjustments. It just makes turning profitable even harder.
And interest rates.
Higher interest rates hit them in two ways. First, as an unprofitable growth company, their valuation is highly sensitive to the discount rate used to value those far-off future potential earnings. Higher rates mean future earnings are worth less today, pushing the valuation down.
Okay.
Second, higher rates increase the cost of borrowing money, the cost of capital. For a company that's burning cash and might need external funding, that makes staying afloat more expensive.
What about specific geopolitical stuff, like the proposed U.S. tariffs for 2025? Any impact there?
Probably more indirect headwinds than a direct hit, but yeah, potentially.
How so?
Well, you could see increased hardware costs if tariffs hit tech components they use in projects. Broader economic uncertainty from tariffs could also lead to disruption in commercial IT spending, making that diversification push harder.
Right, hitting their expansion plans.
Potentially. And any tariffs or tensions around IT services exports could cause disruption in global tech talent markets, possibly complicating future international plans, though that seems further off for them right now. Okay, we have covered a lot of ground here, digging into pretty much every corner of BigBear.ai. Let's try to bring it all together now. What's the optimistic view? The bull case?
The bull case really hangs on that compelling narrative, doesn't it? You've got this enormous market opportunity, the whole AI megatrend. They have what looks like a niche moat with those entrenched government relationships. There's that smart strategic leadership pivot with the former DHS secretary as CEO. And fundamentally, it's a high-risk, high-reward bet on a potential turnaround.
Okay, that's the story. What's the counter-argument, the bear case?
The bear case is grounded firmly in the stark financial reality. We've seen the dismal performance. Stagnant, now declining revenue, escalating losses, consistently negative free cash flow. It's a cash-burning machine in a sector that's supposed to be booming.
Right.
It seems caught in that services trap, acting more like a low-margin government IT contractor, which is hard to scale, rather than a true high-growth software company. And then there's that absolutely damning insider selling. That volume of selling is hard to ignore.
Yeah, the 145 million shares sold?
Exactly. Plus, they look competitively and financially vulnerable. Small, unprofitable, going up against giants in a tough macroeconomic environment.
So let's revisit the valuation. That highly speculative DCF model gave us an intrinsic value range of
$2.50 to $4.50 per share, based on those optimistic turnaround assumptions and factoring in the high risk.
And the stock today, September 12th, 2025, is trading at $5.06.
Correct. So the current share price is trading above even the high end of our speculative intrinsic value range.
So what's the conclusion then?
Our conclusion, based on this analysis, is that the current market price appears to have fully priced in and maybe then a successful turnaround and significant future growth that simply hasn't materialized yet in the actual result.
It's valued on the story, not the numbers.
It seems that way. Valued on the compelling narrative, the association with the AI megatrend, rather than its current, quite poor fundamental performance. Now, they do have unique assets, the tech, the domain expertise, those government ties, but there's a significant, you could say, a gaping chasm between that potential and the financial reality right now.
And for investors?
Well, for a value-oriented investor looking for a margin of safety, there appears to be a substantial margin of safety deficit here. The risks, the poor performance, the cash burn, the insider selling.
Sure.
They don't seem adequately compensated for at the current share price of over $5.
You know, this deep dive really forces us, and hopefully you, the listener, to ask a crucial question. How much weight do you give to a compelling story, to huge market trends, when the actual financial reality paints such a starkly different picture? How do you reconcile that tension when you're looking at these emerging tech companies? Something to think about. Okay, that wraps up our deep dive into BigBear.ai. We hope this gave you a much clearer understanding of the company's prospects and its many challenges. Remember to like this video and subscribe to the Stock Analytics AI YouTube channel.
Please do.
And just a reminder, for $4.99 a month, members get priority on deep dives. We're covering all the S&P 500 stocks over the next few months, exclusive access for members. Or drop us a super thanks for a one-off deep dive.
And now, the important disclaimer.
Right.
This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.
Absolutely critical. Thanks for joining us on this deep dive, and we'll see you on the next one.